Federal Reserve basically has achieved what it wanted to do. If you think about banks are basically how the money gets to consumers and through the economy. When the bank's profitability declines and their equity on the balance sheet declines, the ability to lend decreases a lot. And therefore, this means that most likely that is extremely, extremely destimulative for the economy, what's happening right now.
I am so pleased to be joined in studio yet again by my friend Vitaliy Katsenelson, who is a super interesting dude. Not only does he run a major value-oriented investment management company here in Denver, he wrote a fascinating book, which is the first time I had him in studio, called Soul in the Game, The Art of a Meaningful Life. You can check that out at soulinthegame.net. He writes about financial market stuff, and he has a whole separate website called myfavoriteclassical.com where he writes about classical music. So talk about a Renaissance man. Vitaliy, welcome back to KOA. It's good to see you.
Ross, it's my pleasure. Thank you.
So I see you have a Starbucks cup. Is that because that's your office right now?
That's right. Our office has been remodeled, so I'm living in Starbucks for a week. So
I wanted to ask you a little bit about some market stuff, because you're looking at stocks from a long-term value perspective. This is what you do for a living, right? My financial background is short-term trading. Mm-hmm. I never really thought about fundamentals, and I don't really do a lot of my own market stuff right now. So you're the expert on this. And one of the things that happened yesterday, although bank stocks are up decent today, but one of the things that's happened over the last several days is that bank stocks have gotten crushed across the board, including, I think, you can tell me if I'm wrong, but at least some of the stocks of some of the biggest money center banks that you might have thought would stand to benefit if people were getting afraid of the smaller banks and moving money to the bigger banks to get some safety. And I'm just wondering, from your perspective, how do you think about the bank industry right now and bank stocks? And did what happened with Silicon Valley Bank, I know I'm throwing a lot at you here, is there something that just happened that potentially reduces the value of all banks forever based on what the government might do next?
Well, that's a great question. There's a lot of questions in one question.
Yeah.
All right. So if you think about bank, and let's look at it from two perspectives. You have assets and liabilities. Okay. So the liabilities are basically deposits. And for a lot of banks, they have two types of deposits, interest-bearing and non-interest-bearing. In the previous 5 years, when interest rates were almost zero, it almost did not make a difference because interest-bearing deposits were paying almost nothing anyway. So there was very little distinction there. But banks were flooded with deposits. And in part because of the $5 trillion bailout, consumers were was flushed with cash. So banks had a lot of deposits. Now they had to figure out what to do with them. So what has happened to a lot of banks, not all, they basically invested them in long-term securities, like in mortgages, corporate bonds that mature 10, 15, 20, 30 years out. So in other words, think about it for a second. So your source of funds were security, were deposits that you paid nothing. You had a zero cost. Mm-hmm. And if you bought a 30-year bond, you basically locked in yourself that you'll be getting paid 3% a year for the next 30 years. Now, interest rates go up, and suddenly a couple of things happen. The cost of funds goes from 0 to 3, 4, 5%, whatever the short-term yield of the curve is yielding today. And this is very important. And suddenly, the value of those long-term bonds you had on your asset sides, they decline 10, 15, 20%. And so two things happen. Number one, because your assets decline, you actually, if they were marked, and this is accounting stuff, but if they were marked as held for sale, now your equity declines. If they hold them on the balance sheet as we're gonna hold them until we sell them, then your equity doesn't decline, but except you're born at 4% and you're getting 3%. So your income declines. Mm-hmm. So if you the net impact, if I just had to summarize this, the net impact is very simple. The equity, bank's profitability and equity and how much and book value equity has declined. Now, and that's going to be bank like case by case basis. So if you own a bank where the duration of the assets a year and a half, so they are not impacted by this. But like, I'll give you one example. Like one of the biggest banks in Denver is US Bank, and they have I forget the numbers, but let's say $300 billion of assets. 1/3 of those assets in securities that are 15 years or longer. So they will be impacted by that. So does it mean that US Bank is going to go bankrupt? Not at all. But what it means that the earnings power of US Bank now is going to be decreased. So
okay, so I'm with you on all that. So a third, it sounds like a lot, I think. But like, what's an average number for a bank? Like, what percentage of their assets would be invested in stuff with a duration of a decade or more? What's a typical number?
It's very difficult to say. It's a complex. It's going to be case by case basis.
Okay.
But here's a couple of things. The most important part for your listeners is this: Federal Reserve basically has achieved what it wanted to do. It's basically, if you think about banks, are basically how the money gets to consumers and through the economy. Right, when the bank's profitability declines and their equity on the balance sheet declines, the ability to lend decreases a lot, and therefore, this means that most likely that is extremely destimulative for the economy. What's happening right now?
Okay, so from the market perspective, it seems like everybody just woke up to this since last Thursday, and all of these bank stocks just, got. I mean, I realize there's probably some that have been going down, and you've been paying a lot closer attention than I have. But this seems like a thing that people who invest in bank stocks should have been and probably were paying fairly close attention to for a period of time. So why did all of these bank stocks just get destroyed in the past week? At the same time that people are talking about Silicon Valley Bank as a bank that has not quite unique, but at least unusual business model.
Yeah, I think Silicon Valley is, to some degree, is a kind of an extreme case. But the way market looked at the bank stocks, very simple. If you look at the bank's balance sheets from a credit perspective, they were in the best, they were terrific. Their financials were very, very strong. What people have missed is that, and what also happens when interest rates rise, usually, and you rise slowly, usually what happens, deposits lag behind. So how much the bank is, so banks actually, their margins go up.
Right.
What people missed this time is that because interest rates were so low for so long, banks lent out for so much, the amount of risk they had, a duration risk they had on the balance sheet was so much greater than people realized. Right.
But my point is, and I was talking with Jay Davidson, who owns First American Bank over here in Greenwood Village yesterday on the show. He was sitting right where you're sitting now. That kind of information shows up in, I think, every quarterly report for every bank. So why didn't the big shot bank analysts at Morgan and Goldman and wherever else say months ago, like, these people have some serious duration mismatch? It's like this stuff is like a game of musical chairs. As I said about the duration mismatch yesterday, it doesn't matter until it does.
Because the people usually buy a story.
Yeah.
Like, the banks in the best financial condition, and then they stop looking. So and then that becomes the kind of the narrative in the market, and they stop paying attention to other things. So
interesting.
And also, it's very complex. It's very complex in this way. Nobody expected rates to rise as fast as they did. Okay, and here's the thing: if you worried about, I think actually this is a better answer. If you worried about this for the last 10 years, you worried for nothing, because the more risk you took over previous 10 years, the less money you made.
Right.
Okay.
Yeah.
And you know what happens when you worry for so long, for 10 years, you get sick of worrying.
Right.
And you just you throw in the towel and say whatever.
Yeah.
And I think this is what's kind of like you could have written this about this risk 5 years ago, 6 years ago, 2 years ago, and nothing happened until it did.
Right. That's a great point. Absolutely great point. We're talking with Vitaliy Katsenelson. He's the CEO and Chief Investment Officer of IMA, and it's imausa.com if you want to see a little more about what they do. But it is deeply researched value investing. So let me get to one of the many questions I asked you all at once before, and I don't think we've gotten to it yet. As we think about the government reaction to what happened with Silicon Valley Bank and where they implicitly eliminated the cap on deposit insurance, and they're going to claim, oh, well, this one we called systemic, so we won't do it next time. But no, I don't know. No one's going to believe them. By the way, I think back, and you're old enough to remember this too, when the feds organized a bailout of Bear Stearns and then shocked everybody by letting Lehman Brothers fail. So don't expect consistency necessarily from them. It's possible they won't do this the next time, and then they'll have an even bigger problem. But if you look at what the government did and what the government might do in the future in reaction to this, do you expect something, whether it's a law or higher FDIC assessments or something, that generally lowers the earning power of banks going forward, even separate from all the stuff we just talked about interest rates going up?
Oh, absolutely. The banks should be just like utilities and nothing else. And let me give you one little anecdote.
Wait, you're saying that like as a judgment, you think they should be that way?
They should be, and I think the regulation should make them in a way that like they can't fail. In the sense that
But how is that consistent with a free market capitalist economy?
Oh, here's the thing. When it comes to banking system, if you have a fractional banking system, if everybody loses their trust in the banking system, the economy is done. Like it's just, in other words, let me just very simple. If everybody goes to the bank today and says, "I want my deposits back," we have no more economy. So I think the banks should be regulated in a way that that they basically, if they go bankrupt, they can go bankrupt all the time as much as they want to, except depositors don't get touched. So in other words, when I look at, by the way, when I look at this bailout of Silicon Valley Bank, I think what the government did it the right way. They let the equity investors will lose everything, most likely bondholders as well, but depositors will be bailed out. And let me give you one example, because I did not realize I don't have any money with the Silicon Valley Bank, but actually I do. I did not even know this until yesterday. One of the customers they have is a Bill.com, a company that we use to basically to make our payments. Which our money is not even with our money is with Vectra Bank. So what happens when I send money when I send money from from my Vectra Bank, first it goes to Bill.com that had their money with Silicon Valley Bank. Then they hold it for a couple of days, and then they give it to whoever sending the money to. So we had several $100,000 in transit, actually at Silicon Valley Bank. So imagine, we would have lost a few $100,000 if Silicon Valley Bank went out of business. Even though I did not have a single deposit. I didn't have a penny of deposit there. So now, if you just think about this, if you lost that money, then so suddenly I would have to pay so much closer attention to every single payment I make.
Right.
And if everybody does that, that makes our financial system a lot worse. So what the government should do, they should basically regulate banks to the point where they will have enough capital if they fail. The equity shareholders lose money, bondholders lose money, but depositors are safe. That's and by the way, I'm as you know, I'm quite a libertarian guy.
Yeah.
So,
but don't you think? All right, so let's follow up on this point. If it were possible for depositors to lose money, don't you think that would put a little more pressure on depositors, especially large depositors, to be in touch with their banks enough to and be aware of what's going on at their banks enough to say, you guys, don't screw this up? Or do you think it's just so complex that even a large, fairly sophisticated customer of a bank just can't really see their way through the opacity of these reports?
Well, I think so there was you can look at Silicon Valley banks, and I know Roku had hundreds of millions of dollars. Now they had some big depositors, but there were 40,000 small business guys who are like companies like mine, right? Like we have money at Vectra Bank. You know what I spent the whole weekend? And this is my job. Actually, I was analyzing Zion's bank balance sheet because they own Vectra Bank. This is not how I should be spending my money. I mean, my time.
Right.
By the way, how many people are actually financial analysts? How many people can actually look at the bank and understand, financials. This, should doctor be, if you're a doctor and you're running a small business, should you be focusing on this? Or you have a lot of government entities. Oh, by the way, as of Friday morning or Thursday night, Moody's and S&P rated Silicon Valley Bank as triple B plus, meaning basically it's an investment grade entity. So shouldn't Moody's be concerned about this, and FDIC and many other institutions? So I think, again, if at the end of the day, if it doesn't cost money, to society, and equity holders and bond holders suffer, I think that the free market actually did work.
We're talking with Vitaliy Katsenelson of imausa.com. His really fascinating book is called Soul in the Game, S-O-U-L, in the Game. You can go buy that and read it. That sort of introduced me or reintroduced me, I should say, to Stoic philosophy. I bought the Daily Stoic. I have it on my bedside right now, thanks to you. Okay, back to the investing question.
Yeah.
In the aggregate, separate from issues of what interest rates are now and duration mismatch, structurally, is the banking industry worth less now than it was a week ago because of things that are likely to be done by government?
Yes, and because, yes, you're going to have more regulations, but also it's worth less more because people realized that the equity banks have to make future loans and therefore to generate future income is less than they thought. So it's not worthless, just don't get me wrong, but the earnings power for the system as a whole is less today. It's just because of that is less today for at least some time before they kind of rebuild their balance sheets.
So you don't necessarily think, and by the way, we're not giving trading and investing advice here, but it sounds to me like bank stocks are a fair bit cheaper than where they were a week ago, and some banks are much cheaper than they were a week ago, but that doesn't necessarily mean that you are looking at them as cheap and you got to buy them on a value basis.
It's all relation. So now think about this: the value got cheaper.
Yeah.
For someone, the price declined even more. So it's a relationship between price and value.
Right.
But what I'm saying is, just because something declined does not make it cheaper.
Absolutely right. Absolutely right. And folks should never think about a previous price of a stock as some kind of guide as to where you think it's going to be later. A stock doesn't ever have to trade ever again at a price that it used to trade at, right? A stock could go from 3 to 10 and it might never trade 3 again. And a stock could go from 10 to 100 and never trade 10 again.
Silicon Valley Bank is
there's one. That one will literally never trade again.
Yeah.
All right, I literally have 1 minute left. Tell us something interesting about your recent trip to India.
Oh my God, it's the country of contrasts. Like when I came to the United States from Russia, I've been told America is a country of contrasts. It's nothing compared to India. I mean, you on one side, you stay at this incredible hotel that looks like makes 4 seasons look like 3 seasons. But then you go outside and you encounter the poverty you've never seen before. Mm-hmm. So it's an incredible country. I absolutely loved it, and it's very difficult to describe in a minute. But I wrote an essay about this, and your listeners can read it on my website. If they go to investor.fm. They can read that essay.
Investor.fm.
I know. Sorry.
Yeah. No, that's good. I love visiting India. I'm glad I don't live there. I think the word that describes it best for me is intense. It's really, really intense. And sometimes in great ways and sometimes in painful ways.
And I think one thing what I loved about India is how religion makes this country, like people so kind to you. And that's probably the most important impression I got from India. People were incredibly, incredibly kind.
Fascinating. Vitaliy Katsenelson, thanks for joining me in studio again.
Thank you.